All right, let's jump right in. We're going to break down the real story behind Apple's latest earnings report, and this analysis comes straight from BGVC. So let's get into it.
So, at first glance, everything looks perfect, right? Apple's Q4 results are just, wow, $102.5 billion in revenue. They completely smashed expectations, and a lot of that was driven by a huge surge in their services division.
But you know, the headline numbers, they almost never tell the whole story. And if you dig just a little bit deeper into the details here, something pops up. A potential red flag that makes you ask a pretty serious question. Are these profits even real?
Right. So this leads us to a little detail that might suggest something's not quite right under the hood.
Okay, take a look at this. This is where it gets really interesting. You see that revenue grew by a very healthy 8%. But then, look at the bar right next to it, Accounts Receivable. That shot up by over 19%. That's more than double the rate of sales. And let me tell you, in financial analysis, that kind of gap is a classic warning sign.
So why is that a big deal? Well, first, let's be super clear on what accounts receivable even is. You can just think of it as a big pile of IOUs. It's money that Apple is owed by its customers, you know, the Verizons and Best Buys of the world, for stuff they've already shipped out but haven't been paid for yet.
Now, when that pile of IOUs starts growing way faster than your sales, it can be a symptom of something called channel stuffing. That's a fancy term for when a company tries to make its sales numbers look bigger by basically forcing products onto distributors that haven't actually been sold to real people. So yeah, we've got to look into this.
All right, time to put on our financial detective hats. We're going to follow the clues and figure out the truth here.
So here's the plan. We're going to run a little 3-step check. We'll look at inventory, we'll check their guidance for the future, and then we'll hit them with the cash flow statement.
Okay, clue number 1, inventory. Now, if that channel stuffing theory were true, you'd expect to see inventory piling up, right? Unsold iPhones everywhere. But what actually happened? Inventory fell. And not just by a little, it dropped by a massive 21.5%. That doesn't scream, we can't sell our stuff. It screams, this stuff is flying off the shelves.
All right, clue number 2. What do they say about the future? See, if you were borrowing sales from the next quarter to make this one look good, your future forecast would have to be pretty weak. It's just simple math. But Apple? They did the complete opposite. They guided for accelerated growth, even stronger sales for the next quarter. That just doesn't add up with the faking it theory. And that brings us to the final piece of evidence. The ultimate lie detector, the one document that can't be easily fudged, the cash flow statement. This is where we see if all those profits on paper are actually turning into cold, hard cash in the bank. And here it is, the smoking gun, 99.5%. That's the percentage of Apple's net income that turned into actual operating cash. That is just incredible. A number that high is what you'd call the absolute golden standard for earnings quality. It means the profit is real. So how does that work? This table breaks it down perfectly. You start with the net income. Then the cash flow statement correctly accounts for that big jump in IOUs, the accounts receivable, as cash that just hasn't come in yet. So it subtracts it for now. But when you factor in other things, like the cash they got from selling down that inventory, you see that the final cash flow number almost perfectly matches the profit. Mystery solved, the profits are real. So what's the real story? Well, it turns out that red flag wasn't a red flag at all. It was actually a massive green light.
That big spike in accounts receivable, it was all about timing. The new iPhone 17 was a massive hit, and they shipped a ton of them right at the very end of September. The quarter closed before the checks from the carriers cleared. That's it. It's a sign of huge demand, not financial manipulation.
And this kind of high-quality profit doesn't just happen in a vacuum. It's built on an absolute fortress of a balance sheet. I mean, look at this. They have zero goodwill on their books. That means no risk of having to write down some overpriced company they bought, which is a huge deal compared to other tech giants. Plus, they're returning just a staggering amount of cash to shareholders.
Okay, so now that we've established the numbers are solid, let's talk about the future. Because what this investigation really uncovers is the real story. The whole investment thesis for Apple is changing right before our eyes. It's shifting.
And we see the evidence for this pivot to AI in 3 key places: how they're spending their money, their whole approach to buying other companies, and their strategy for actually making money with AI.
Now this quote from Tim Cook himself, this is a really big deal.
You have to understand, for years and years, Apple's playbook has been to only buy small companies. This statement is a complete 180. He's basically signaling to the world that they're now open to a huge, game-changing acquisition in the AI space.
So how are they going to make money from AI? It's actually brilliantly simple. See, unlike other companies who are trying to sell you an AI subscription, Apple's strategy is to use AI to sell you a new phone. Apple Intelligence is going to be the new killer feature that's so good, you'll feel like you have to upgrade your hardware just to get it, and that could kick off the next massive supercycle for the iPhone.
So, that's where we land. We've put the financial fears to bed, and in the process, we've uncovered this fundamental pivot in their strategy. Which leaves us with the one big question. Is AI about to drive Apple's next trillion-dollar supercycle? That's the real story to watch now.